Good morning once again, everybody. You're very welcome to today's webinar. This is HFM, and today we're talking about trading execution. When you have decided what you want to trade, you have done your analysis, you have figured out what you ought to buy, what you ought to sell based on your market research, fundamental analysis, sentiment analysis, and then you get to the chart. How do you execute the trade? At what point do you jump into the market, or at what point do you jump out of the market? How do you determine your entry price, your entry point, and your exit point from the trade? Remember, through the technicals, there are quite a number of different instruments readily available to trade. And based on strategy, there are so many different methods that different people use when it comes to executing their trade. So the question is, of all of them, how do we separate them? How do we identify high quality ones? How do we make the most out of it so that we're able to better utilize the trading opportunities that we find? Remember that it's important to know that entries and exits are a key part of your trading. If you can learn how to filter through the charts, look through the charts, look at price behavior, look at price movement, and find quality execution points, it can contribute massively to your performance in the market, right? So we're going to talk today about these execution points, these entry and exit levels. We're going to talk today about what to look for when you're trying to trade. We're going to talk about confirmation tools and techniques, right? And also, we're going to talk a little bit about the risk area, right? Predefining your risk, anchoring your stops, managing your trade. We're going to talk about those things as the day progresses, right? So we're going to run through that very shortly. But please, I'd like everybody to confirm to me that we're all on track. We can hear me loud and clear. We're ready to see we can see my screen and we're ready to go. So please, the Q&A of this chat box is open. Please click on the Q&A and send a message confirming that you can hear us loud and clear and we're set to go, right? During the course of this meeting, this webinar, if there are any questions that you may have, anything at all, right, relating to this topic, please click on the Q&A session and leave me a message there. I will get it. The chat box is disabled. We prefer the Q&A so we're better able to track the messages and then make the most out of it. So we're going to go into that very shortly, but please, I need your feedback that you can hear me loud and clear and that you can see my screen. Quite a number of messages already in, so I think that works for us. I'm going to run through this very quickly. Quite a number of messages coming in from the Q&A. Okay, that says it's working loud and clear is most of what I'm seeing right here. Loud and clear. Good afternoon. Loud and clear. Loud and clear. Loud and clear. All right, great. I think that works fantastic. Now we're going to cross over quickly to the charts, and then we're going to get talking, right? Looking at the chart like this is a chart, a simple chart. I want to believe that being in this class, you're not extremely new to trading, right? You're not extremely new to trading. You have been trading before now, right? If you're new to trading and you don't know anything about the technical side, maybe you've not really been familiar, with the technical part of the information, then I would like to recommend that you join the HFM Foundation course. It's a course that runs weekly, Mondays to Wednesdays by 3 p.m. in the afternoon online, right? You could join, if you reach out to your account managers, you could get the link to join the training. You could also, catch the video. We had recorded the video of the foundation course on our YouTube page. You could catch the video and you could register. Just not need to register, just cut the video on our YouTube page, HFM Nigeria. It's called the foundation course, and you could watch it. And we've also done previous webinars as well that are also uploaded on our YouTube page, talking about support and resistance, technical entries, trading tools, different things, right? All of these things are on our trading platforms and you can get it. Now, very quickly, I'll be talking more from an angle of you have basic information about technical analysis, right? We already know the strategy we want to use, but we're just talking about how do we confirm the entry? How do we know if that area is worth placing the trade? I've had people tell me that look, they're afraid of placing pending orders because by the time price gets there, at that point they're now undecided. They're no longer super sure whether they want to be there or not, right? So they rather just wait it out, and they end up waiting till price tests the level and continues in their direction without them in on the trade. And that bad and sour feeling makes them feel like next time they must not miss the opportunity. But then the next time they jump in without the full information in play. And of course, that also, contributes. So all of those things are things that, we want to also clarify in our class and make sure that we have that information. Now, let's say, for example, what we trade or what I trade, what you trade is simply price action, support and resistance, right? We're going to use that as a major bone of contention. And we're going to talk from there. Now, you see, before we go deeper into that, there's one thing I want to make very, very clear. Technical analysis are very important. Looking at the charts, finding opportunities to enter the market is very, very, very important. But the truth is, it goes beyond just charts. It goes beyond just charts. The idea that you would look at a key technical level and based off that key level, you execute a trade without having some basic information as to why you think price should go in that direction is a problem. I'll give you an example. Purely technically, right, you could look at this particular chart that we're on, and you could pull this up and say, okay, we have quite an interesting level here, right? An area of support, sorry, resistance, another area of resistance, quite a number of it, right? Resistance again, support again, even though there was a gap right there, price eventually broke through the level, and now price is here. Purely based on technical analysis, this is a resistance area, and we agree that we should sell from resistance. So normally, someone will want to feel like, look, I can sell from this level. Let's sell from this level. But what I'm saying is just looking at the technical charts alone and executing your trades purely based on the strategy without knowing what's happening and why you think price should go in that direction may not be the best approach. I could sell from that area right now. But what if today we have a positive market sentiment? What if today Australian dollar is really, really strong? Riding on the jobs data that we had, I think on Tuesday, where they were expecting about 21,000 new jobs and they got about 89 or maybe 90,000 new jobs. What if that's the reason why AUD is strong? What if the trade deal between Donald Trump and China, US and China, the pending deals between US and India, US and Saudi Arabia, what if all of those things are very positive in the markets and is making sentiment to be improved, making AUD JPY to rise? What if US is trying to also increase their interest rates? And of course, that yield differential is weakening or pressuring the yen. Are we together? What if those are the cases? Now, you see, if you don't have all that information, at least some of them, or what is currently important, right, as part of the information or your tools for making that decision, then it's very possible that you start to jump into the market purely based on the technical side, and then the fundamentals or sentiment do not agree with you. So it's important that we agree from the very beginning that as a trader, you must have that basic information that powers the idea. Your strategy is for execution, but before you execute, you ought to have a plan. The plan is, what is the fundamental saying? What is the sentiment saying? What is going on in the market? Should I be buying this currency right now? What is making the price strong? Am I paying strength versus weakness? These are the questions that you should ask yourself before you get on to the chart. When you now get onto the chart, right, how then do you execute? Of course, you already have your technical strategies, but let's talk about a few things. Let's assume for some reason that we should be selling this asset. I'm assuming that we've already done our analysis and we agree that we are supposed to be selling. Now, we're supposed to be selling, we're ready to sell, and we come on board. The next question will now be, if you look at this and I pull up maybe just a purely resistance level. Yes, based on support and resistance, we could agree that it's a resistance level. It's proven itself at least over the last few days on the chart, almost through the month of May, and it's been solid. Oh, I want to sell. I'm assuming that you already have a reason why you ought to sell. Please, that is non-negotiable and it forms a big part of what is going on in the market, right? You must make sure you already know that area, what is going on before you come here. You cannot just say you are selling without having some basic information about why you think price should fall. So I'm assuming we've already done that. And now I have come here. How do I know that this level makes the most sense to sell from? Why not this particular level? Because this is also another interesting area of resistance. We see we have also one, two, resistance, eventually broken, serve the support, try to hold again as support, eventually broken. Who says that I'm not expecting, or I cannot expect price to behave like this? Let me see if I can get some drawing tools on the board and show you what I'm saying. So we agree we want to sell. Price has broken through this interesting area, right? We saw price come up here, test the level, come down, test the level again, come down, eventually broke above it, tests as support, and continues higher. Now we've broken back below it, and we're testing as resistance. Since I want to sell, you may want to agree with me that somebody may think selling from here makes sense, and I expect price to go down, maybe even retesting the previous lows, around this level. Well, I mean, that makes sense. But the question is, if you look at this other line that I picked up, that's also interesting. We had resistance here, we had another resistance here. Let me see if I can clean up all the drawings and get you new ones. We had resistance area here. We had another one here. Eventually it was broken, served as support, went higher. Now it's broken, lower. Who says that price cannot retest this level again before continuing lower? So the question is, do we get this or this? How do I know which of them I should be trading? How do I know if I should be jumping in from the first level, level A, or the second level, level B? Technical analysis has a bit of discretional components to it. What I mean by that is, as a trader, a lot of times when you get to the chart, it's more about what you can see. Depending on what the catalyst is, depending on how big the driver is, both levels can be very, very valid. For me, the first level, I like it. But the second level cannot be ruled out. And you cannot know for certain where price will, what price must do. There's no way to tell you that way ahead of time. And that is why confirmations can also be very, very important. And they can also help us in making decisions. Please don't forget, like I said, I see some hands being raised. Please, I may not be able to take, unmute the microphones, but if you have any questions for me during the course of this class, I welcome them. Please send them in the Q&A. I will get into them and I will respond to them. Are we together? All right. Now, I don't have any questions for now. Confirmations are very important. Some of the confirmations that traders can use are to look for how prices respond to that particular area. Having marked both of them out, seeing how prices respond at that level, or looking at the lower time frames to see how prices respond at that level could be a way to confirm if you should be entering the market at that point or you should be more patient. I'll give you an example. Let's say we have a level here. So let's assume we have a particular level here that we want to trade. All right. I'm just trying to change this a bit and make it a bit colorful so that we can better use it. Okay. So let's say we have a level here that we want to trade, right? And then you're expecting prices to pull back to that region, right? So you're expecting something like prices have been moving like this, candles have moved lower, and then you have another one, move higher, and then you have another one, move higher. Now prices have finally broken below that level, right? And then of course you're looking for a pullback into that region, right? And you start to have the pullback. And price is now approaching the level. When price gets here, first of all, it's not enough to just say, oh, because price is at resistance, I must jump into the market to sell right now. No. Sometimes you want to, if not sometimes, a lot of times you should try to wait to see how this candle closes. Because there's a big difference if this particular candle that tests the level closes like this, and if it closes like this, with a little bit of, a little, wick right there. Let me see if I can draw it, right? There's a big difference between a close like this and a close like this. The fact that price tested this level, right? Yes, it's what you want to see. But sometimes waiting for confirmations also contributes strongly to how you or when you actually decide to step into the market. A big push like this shows that in this case, buying momentum is still very, very strong. And that may mean that you should be a little bit more patient on your own execution to sell. Why? You want to be sure that the price or market wants to use that particular level for anchor to enter. Now, you cannot be certain, but you want to see signs on the chart that there are sellers present at that level and they are also being very evident. Now, this is after you have confirmed that you're supposed to be selling. If you have a clear rejection, like what we are seeing right now, like this first one, if you have a clear rejection like this, and the candle eventually tests and closes back below, then that's great. That is a confirmation, at least to some extent, that, oh, sellers are very present in that level. And of course, you can also be confident in stepping into the market on that light. But if you see something like this, you want to be more patient with that. So, of course, looking at how prices respond to that particular level is also very, very important. Or let's say you see this price close above and immediately prices close back below the level. Okay, that's also a good sign. Back below the level, right? And then the following candle, of course, sticks below. That's also a good sign. Sometimes you may want to even drop down to a lower time frame to see how prices respond at a particular level. If you're seeing hesitations, you're seeing rejections, then of course it is a better sign, or it adds to your confidence level on that particular trade. If you're seeing hesitations, let me see if I can draw a little bit of that. So when price got to that level, price started struggling around this environment, couldn't really go past that level, maybe a little bit of weak, but eventually, closed back below it. Price struggled quite a bit. Of course, that can also be a sign for you as well. If it lasts or tarries for too long, of course, it can start to bring a bit of second guessing. If price should be going down, it should start going down from there. Why is price delayed? What is going on? Are we together? So it's not just about just jumping in blindly. Sometimes looking at how the prices respond at that level is equally important. Looking at my chart, let me see if I can find a bit of, entries or levels for us right now, right? Looking at the candlestick formation itself too can also be important, right? If price tests the level, like what we have here, let me look at this example and show you. If price tests this level, and then, of course, the candle that closes it, right, that tests the level, follows, or the candle that follows the candle that tests the level is a massive engulfing candle that engulfs the previous candle, for example, right? Just using this as a very simple example, even though, yeah, the wicks are still very close, but let's assume this is a massive engulfing. That can also be a good sign for buyers. Of course, you notice that price continued downwards. Yesterday, AUD was beating heavily to start the day. AUD, not just yesterday, even on Wednesday. So that means that before you even try to consider the candles, the levels, price reactions around those areas, of course, you must make sure that you ought to be buying that asset in the first place. Let me look for other examples and show you what I'm saying. Now look at this. Trying to look for key levels and see how prices responded at that particular area. Now, look at this particular one right here. So let's assume we're looking to also buy this asset. Price tested the level, moved clearly around it, move back above it. Now came back to test that particular area and want to see continuations from there. Of course, how the candles respond, if you're seeing clear rejections, long wicks from the bottom of the candles, it shows, at least to a large extent, that buyers are very, very present in that area and are looking to push prices up. But what would eventually make prices go up is in the driving force, the factors that actually influence the price. Are we together? Some people also look out for not just engulfing candles, look out for pin bars, look out for other candlestick formations. But I personally do not use a lot of candlestick formations on my chart. So let me look for something also very, very neutral that a lot of traders also pay attention to. Sometimes looking at the candle that you're looking for a retest, where it closes is also important. Another thing, the first thing would be how prices respond around that level. But a lot of times, waiting for the close of that candle is important. Now, at this point, the time frames also play a role. You remember that on a 30 minutes time frame, for example, the 30 minutes candle would have closed in 30 minutes while the 1 hour candle is still running. So, of course, you want to make sure that you are also looking and staring at the appropriate time frames. You want to make sure that you're also looking at the appropriate time frames. But that being said, looking out for the close, how the candle specifically closes at that level is also important. If I want to see prices rise, I want to buy from this area, for example, right? Or let's use this particular one since it's more in line with what we're looking for. Now look at this area here. Let me delete this off so that it doesn't confuse us. Now look at this. So I want to sell from this area. If this particular candle closed above this level, right, that could have been a concern. Making sure to see that the candle closes below the level can also further qualify an area as a quality environment. That is only after you have already done your analysis and you are convinced that you're supposed to be actually trading that instrument. Are we on the same page? Another thing is there are traders that also focus on different tools, other tools for confirmations. For example, Fibonacci tools. Fibonacci retracement level can also be a useful tool in trying to figure out if a level is more important than the other. Now look at this. In this case, we have two options where we want to sell from. If I pick a Fibonacci retracement tool and I draw it up from my chart, you would notice that this particular 23.6 level coincides perfectly with this first area of resistance. That could also add to my confidence level around this particular chart. I may have been thinking, oh, do I sell from level A or level B? But adding the Fibonacci tool to it can add to my confluence, add to my level of confidence that that level makes sense because mathematically, price has pulled back 23.6%, which is a major focus point when it comes to looking for reversals or pullbacks and continuations. I hope this makes sense. So sometimes adding tools like the Fibonacci retracement level could also contribute. Apart from seeing how the candle responds, you look at this, for example, when prices are around this particular level, right, the rejection from that area was just perfect. You notice how price pulled back to that level, did not close above it, closed at the level. The next candle was also a bearish candle. I wouldn't know if we can't call this an engulfing here, but then it closed below it. Price remained at that level, hesitated, but eventually, when price even tried to come above the level, there was a massive rejection from that area. These are the signs you're looking for. When you see rejections like that on the candlesticks, it also helps. You could also add other tools like what I've just mentioned now, the Fibonacci tool that can also help you know if that level makes sense. Now, this is if you're actually supposed to be selling in the first place. Some other traders go as far as adding other tools to their trading platforms. Tools that can also help them with confirmations. Tools like the moving average. The moving average can also help us in having that information. Let's really just find a very simple one and just put up there. I'm just going to pick a 50 and just put up there. Now, this is a 50 hourly moving average. Put it on the screen as well. It can also in itself, it is also an area of support and resistance in and of itself. And a trader can also pay solid attention to ensuring that it is very, very useful to us, when we step into the market and when we step out of the market. So I have decided that, I want to sell from here. I have put the Fibonacci retracement tool and I like the level. If, for example, this level also coincides with the moving average, now what setting you use on the moving averages could now differ, but if it coincides with the moving average, it also contributes to the confluence that you have on that chart. Am I making sense? You see, sometimes it depends purely on how you want to approach this. I'm not saying that everybody has to use the exact same tools, but there are different tools that people use, that traders use, that we use as well to try and qualify the areas. But what is most important is you should know this. Your price levels, right, are more useful, more solid, more resilient if you are trading in the right direction with the markets. Right? Absolutely. If you are already selling what you should be selling, you don't even need too much on the charts to make decisions. Prices pulling back to that area is enough. One or two confluences, like looking at exactly how prices respond at that level, rejections at that level, bounces of support, stuff like that could also contribute to what you're trying to do. Traders also go as far as using other tools as well for confirmation. Apart from this, you sometimes see things like overbought, oversold indicators. Let's put up the RSI. Let's say at the time where I'm trying to sell, prices on the RSI, right, the bar of the RSI is already in oversold region. This line, let me see if I can draw and give you an example of what I'm referring to. This particular line has also gotten above this 70 level. Now, of course, anytime prices get around this particular area, right, it is said to be overbought and is expected to start to fall from that environment. Of course, we know that sometimes overbought stays in overbought environment for longer, but ideally, it means that it has gone up so much and some downsides may be expected. Now, imagine if you already want to sell. You already found a key level of resistance. There's already rejections on the candles from that particular area. We're even seeing massive hesitations to go above that particular area. The Fibonacci tool also confirms price to be in that environment. Now, of course, the RSI is also showing you overbought environment. All of these are sell signs. They're more like foster or further improve the area that you're trying to enter into the market from. I hope I am making sense. Now, please don't forget, I have a couple of questions already listed here, right? I have a couple of questions already listed here. I want to also leave the floor open. If you have questions, you could also send them in. I'll look through now and see if I can take them at this time. But for now, we don't have a question that I want to respond to yet. We'll get into them. Just a few moments. I want to make sure that we attend to them accordingly, right? I'm seeing things like time frames. I'm seeing things like confirmation. Right? I'll get into the questions, but we'll get into that. Just give me a few minutes. We'll get into them very shortly. All right. So this can help. You see, understanding these little things to add. Now, I'm not saying that you have to add everything. You could add one. You could use two. You could say, look, I'm only going to look for candlestick confirmations, maybe, shooting stars and engulfing candle, stuff like that. Or you could say, you're only going to wait to see how that particular candle closes. If the candle closes in the line or the direction that I'm trying to trade, I will go into the market. Or you could say, I would always use Fibonacci's to add to my area. If my area of interest also coincides with a clear area on the Fibonacci, then I will go through with it. You could use only one or maybe two, but do not now not even bother to recheck your area of entry. Also, on the other hand, do not now overload yourself and overly scrutinize and scrutinize. You just need one or two excuses to be in the trade, particularly if you've already done your analysis and you already have the ideas, the reasons that back up you being in that direction, and you understand why you think price will move alongside that direction. I hope this makes sense. Another thing I want to also say, right, is sometimes, you see, you could have every of these your tools agreed that, oh, we should sell from level A like this, everything in line. But the mere fact that another area also exists, which cannot be ruled out, would mean that as a trader, you should also consider that level when you're deciding on your stop loss. Stop loss simply involve you paying attention to what you're willing to risk. Placing stop losses just anywhere on the chart may not necessarily be the best way to approach the market. You want to make sure that where you're putting your stop losses accounts for what we call price oscillation. Look, markets are not perfect. And the fact that prices could get to your area of entry does not mean that prices must start going in your direction from that moment on. There are times where prices respond at that level, and still moves a bit above it if you're selling before eventually going down, or still a bit lower if you're buying before eventually going down. So setting your stop losses, the way I like to look at it is, if I decide to sell from this first level here, level A, I like to put my stop loss above level B. The way I'm seeing it is, if this level does not hold, despite all my confirmations, and price still oscillates above it a little bit, if this level does not hold, despite all my confirmations, and price oscillates above it, this other level should at least hold price. Because, of course, since price should be going downwards, right? This particular level makes sense for sellers, considering the fact that it has been an interesting area of resistance and support in the near past. It also coincides with the 23.6 level of Fibonacci. But in a case where it does not hold, the next area that sellers would also be looking to defend would also be right here. So I'm leaving this room between the first point and second point as the area of defense. The area where I want to ensure that even if price goes away above my entry, it should still stay. So hiking my stop losses above this allows me counter or account for both possible tests. Either, let me see if I can clean this up a bit. Both possible tests. Either this particular one, my stop loss being here, expecting this to happen, or even if price does this and continues like this, whichever the case is, I'm still well within where I should be. So the idea is you want to make sure that when you're looking for confirmations, when you're trying to perfect your entries and your exits, always, always, always take a second look at it. Do not just put your strategy on it and just run with it. Sometimes waiting a little bit, seeing how the candles respond, seeing how prices respond to these levels can also contribute a big deal. Can allow you to be more patient a little bit with your trades, delay your entry for a bit, enter at the appropriate time, or even account for drawdowns where you ought to account for drawdowns. I've had questions where traders ask me and say, look, putting my stop loss above the next resistance if I'm selling or below the next support if I am buying, right, may be too much of a risk to handle. That if the distance between here and here is about 70 pips and I do not want to risk 70 pips, how do I manage it? My answer to this is it is better to reduce your volume or lot size than to cut short on your stop loss pip placement. It is better to cut short on your volume, reduce your volume. That is, if, for example, I am trading one lot, as an example, and where my stop loss ought to be, based on this explanation, is 70 pips. 70 pips on one lot is about $700. If I feel like, I'm just as an example now, if I feel like, oh, I don't want to risk more than $300 on it or more than $400 on that particular trade, instead of reducing my stop loss in pips to 40 pips, I'd rather cut my volume from one lot to 0.05 or 0.5. That way, I will still maintain the distance in my stop loss for pips and I will still account for the same amount in risk. I don't know if that makes sense. A lot of times, paying attention to the volume and then configuring the volume to fit your stop loss placement is more important. Let me show you something. You'll notice that on the risk percentage calculator at HFM, nobody really asks you what volume you want to trade. What is asked is, where do you want to put your stop loss? It is now based on where you want to put your stop loss that the volume is calculated. Let me show you. If you go on our website, under tools and education, you will see trading calculators. The first one, particularly, that helps us calculate lot size, you'll notice that the way it works is it asks you where you want to enter the market, your open price, which you would know based on support and resistance. And it also asks you where you want to put your stop loss. It is based on that and how many percent you want to risk that it will correct your lot size. The problem or the challenge is for a lot of traders, they decide already what lot size they want to trade before they even think of where to put stop loss. So they now end up configuring the stop loss, squeezing it to fit into what that lot size already said. It should be the other way around. You should first determine where your stop loss ought to be. Then, based on that number of pips, coupled with how much you want to risk, now configure your lot size to fit into that scenario. I hope this makes sense. So when it comes to looking for quality areas of entries and exits, look, your strategy may not be the problem, right? If you came here thinking, oh, it was the strategy that was the problem, strategy is not the problem. A lot of times your strategy is already fine. Make sure the first thing that you must take away from this is make sure that number one, you are trading in the right direction. How? Ensure your fundamental sentiment analysis backs that idea up. A good trade is a technical trade which has a fundamental or sentiment driver. There has to be a reason why you're in that trade. When you already have that information already in line, first of all, your technical analysis will just help you just stay into the market, right? But even with that, you still sometimes need a little bit of confirmations. The confirmations will come in form of the shapes and sizes of the candlestick formation. If you don't use candlestick formation, you can look at price action, how prices respond at that level, where you have technical bounces, rejections, support bounces, all of those kinds of things. You can look for that. Bounce of support and rejection at resistance can also help. Or looking at how the candle closes at that level. If I'm trying to sell and price test the level, but it closes back below the level, very good. Oh, I'm trying to buy, price test the level and closes back above the level, very, very good. I see massive support bounces of support, price gets there, and the reaction is very strong. That's good. I could use tools like moving averages, Fibonacci's, for example, RSIs. These are tools that can also assist me in making sure that I am looking for the right things. And of course, my stop loss must account for whatever extra layer of support or resistance is just after. So if I'm buying, my stop loss should account for the next support and be placed under it. If I'm selling, my stop loss will be placed to account for the next resistance and be placed above it. Our time is running. Let me see if I can take some of the questions before our time runs out. Now, this particular question from all right, from Andy says, kindly confirm the minimum time frame for confirmation. Now, I've heard times and time where people talk about, doing analysis on the higher time frames and still coming to the lower time frames for confirmations. Well, I understand that, but I think for a lot of people, that is easy. Your mind can manipulate you into thinking or finding or creating the scenario that fits the narrative in your mind. Let me tell you what I'm saying. So, for example, I am looking for a clear engulfing signal at the level that I'm trying to trade. Normally, I did my analysis on the 30 minutes time frame. So I now go down to the 15 minutes time frame. I don't see it. I go down to a 5 minutes time frame. I don't see it. If I now get down to the 1 minute time frame and I now see someone engulfing there, that may now be the justifying fact that makes me take the trade. So sometimes moving around different time frames can make you coin the scenario or overly highlight what you should have underestimated just to fit in the narrative that you have. So I'm not the biggest fan of running through time frames like that. I think for a good number of traders, you could look for your confirmation on your execution time frame, or maybe just the next one. But don't now use that as an excuse to look through all the time frame, squeeze, zoom in, zoom out. Make sure that you create or look or find one small sign to just confirm what it is that you already want to do. I hope that makes sense. For me, my confirmation is done right on the same time frame, or at most the next lower time frame. Thank you for great work. Please, what are confirmation candles? Now, I want to call them confirmation candles, but sometimes some candlestick shapes and types of candlesticks can serve as confirmation. For example, looking at how, the candle closes, looking at maybe a solid bullish signal or a solid bearish signal, like a shooting star, for example, can be a solid bullish signal that a trader can also use when it comes to taking trades. Same thing with the bullish engulfing. So if already I am looking to buy at a particular level and I see this bullish candlesticks formation right there, it could also help me as well make a choice. I hope I make sense. This one says, is it okay To depend on on a close candle on a lower time frame, I use a higher time frame to enter the market. These are the issues that I struggle with in trying to navigate having different time frames and choosing which one to go. Because at the end of the day, you will still coin a scenario to fit what you want to do. Right? So I don't know if you want to look for confirmations, close candles on the lower time frames, and then go up to enter the market. I feel like you could better still stick to the same time frame. I would rather do my analysis, find the level on a particular time frame. Then if I'm looking for a close or looking for a confirmation, I would love to stay on that time frame. But sometimes if I want to, I may want to go to just the next time frame to make that decision. How do we get accurate directions? Now, accurate direction does not really come from the chart. You see, the role of the technical chart is to help you confirm, right, the bias that you already have. That is, find an entry point, execute the trade. Knowing the accurate direction is through your market analysis and research, something that we have covered a couple of times at HFM here. You could also do that. You see, by understanding what is going on, what is driving price, you can know where price is headed. And then you can now use your technical analysis for execution into the market. One thing you can do is you could try to catch the videos that we've done on fundamentals and sentiments, or better still, join the foundation class. It will run Monday to Wednesday next week. Just join it very quickly from Monday. We'll talk about this particular area specifically on Tuesday. You could get the links from your account managers. It starts by 3 p.m. and then you could join us there as well for next week. This one says, how does the RSI indicator? I've done a video on this, a full video on RSI and one other indicator. Just check our. Let me see if I can, share that with you right now. If you look at this, is one thing I want you to always do, right? All of these videos, even this particular one, we're still going to upload it and post it on our YouTube page. But let me show you. If on YouTube, if you just simply go to HFM Nigeria on YouTube, um, what I do? Okay, sorry. You simply go to HFM Nigeria on YouTube, right? And then you search for RSI, for example. We have done a full, you know, um, we've done a full technical, what's it called, a webinar about 8 months ago on this particular topic. So if you want to know how the RSI works, you can quickly come here, search for it, and then you can work on it from there. I hope that makes sense. So you can do that. All right. This question says, trying to run because of our time. I shouldn't keep us longer than I should. Please, sir, what about combining moving averages, 50 and the 200 EMA in one chart? Yeah, you can. We've talked about moving averages as well. I think I talked about moving average crossovers too. Let me see if I can find that for you. Right. Moving average. Right? Yes, you can. There are strategies that depend solely on combining moving averages. You can see we've done something on moving averages as well. You could catch that, particularly on moving averages. So we'll talk about the role of moving averages, combining them. You could catch that. There are strategies that depend on combining moving averages as well. So yes, if your strategy allows you to do that, please, there's nothing wrong with it. This one says, what do you use for EMA and the FIB? Now, for the moving averages, personally, I use the 50 simple moving average. Personally, I use the 50 simple moving average. That's when I'm using moving averages. And for the FIB, I just use the levels that 23.6, 38.2. I use the levels there, right? I do not get too engrossed into one particular one instead of another, right? I talked about all of those levels right here on this particular video, so you will catch that. But it depends on what you're trying to do. Some people use other moving averages, but for me, for sentiment-based trade, for day trades, I like the 50 moving averages. It makes a lot of sense to me. Can I use the stochastic instead of the RSI? Well, yes, you can. The stochastic also gives overbought and oversold signals, right? It also gives convergence too as well. So you can, if you prefer the stochastic, because it does very, very similar work. If you prefer the stochastic, by all means, you can use that. Can we get the recorded message, even if it's on HFM YouTube page? Yeah, we'll try to upload this particular webinar and put it on the HFM YouTube handle, HFM Nigeria. So you can catch it just like you can catch this one. After some time, maybe later today or tomorrow, you can search for it and then you can catch that as well. start studying candlestick formations, confirmations. That's great. You could also, learn more on that and then use it. I don't think we've done any specific video on candlesticks, but of course, we still have a lot of topics scheduled for the year, so we can also work with that as well. All right. Good afternoon, sir. God bless you for this training. I want to ask concerning the Fibonacci retracement indicator. Is it that the 78.6 level isn't needed because I can't see it on yours? Now, let me even check. I don't think it was intentionally removed. I don't think it was intentionally removed. But by default, the 78.6 is not there by default. What you mostly find are 23.6, 38.2, 50.0, and 61.8. So, first of all, if price retraces up to 78%, I think it's no more a retracement, it's more like a reversal at that point. So, I think the more average ones, the 38.2, the 50.0 are more solid areas on the fib that I would focus on. Anything beyond, even 61.8, I'm skeptical about it. But anything beyond that, come on, I think it's a bit, stretched. I want to know all the important confirmation tools so I can pay attention. I've mentioned them right in the meeting. I'm sure the question came in before I mentioned quite a number of them. Our time is running. I've answered this question, Mr. De Jumo, about the Fibonacci retracement tool. Let's see. Is this recorded? Yeah, Madam Patricia, yes, it is. We'll see how we can get it up as well and post it up for us. Please, can you show us again how to use the PIP calculator to determine stop loss? My screen was off at that time. You know what I'm going to do? I'm going to even share the link. I think I still have the link. I'll share the link in the chat box now with you so that you could just click on the link there and it takes you there as well. You could have that information right there. Our time is up already. I want to make sure. Please highlight if a person can use a single time frame to analyze an exit trade. Yes, 100%, Mr. Suleiman. You can use a single time frame to analyze and a single time frame to execute. For me, I think even getting started and then looking through different time frames can even be more confusing than it even helps getting started. But if it doesn't confuse you, yes, there may be value in trying to navigate different time frames and looking at what markets are saying across the board. But one time frame can do the job, right? I'm confused on the talk about anchoring your entry on sound fundamentals or sentiment. How can we explain the recent USD CPI, which ought to be significant but never impacted the market? And let me say this. You see, when it comes to fundamentals and sentiment, it's not only data. Right now in the market, markets are not attentive to data at all, at all. Economic data have not been the biggest influencers in markets for a while now. And that's because markets are distracted. Markets are paying attention to trade, geopolitics, tariffs, you know, deals. This is where market attention is. So as a trader, it's not just about saying, oh, I must trade CPI because it's high impact. The question is it currently the focus in the market? And fundamental analysis goes beyond just CPI data or economic calendar. It goes beyond it. Similarly, sentiment talks about the mood in markets in general. So it's always a function of what you are trying to do as well. We go through the foundation course where we talk about finding trade opportunities, right? And then one of the things I ask that we do is first find the sentiments in the market first. When you figure out what the sentiment is, find the stories in the markets. These stories could be data, like what you mentioned, could be geopolitics, could be policies, could be commodity prices, could be a number of things. But find the stories that confirm why markets are feeling the way it's feeling. Then you move to the markets, find how markets are reacting. There's a certain way commodities, indices, and currencies ought to behave under these risk on and risk off market sentiment. So the question is, are they moving in line? Are we together? Find that out. The next thing would now be, oh, when you have figured out how the currency and assets are behaving, then you generate the idea. So economic data is not the only factor that drives price. Now, if you don't have that information, or you probably have not gone through that part of the training, I would encourage that you do. You could join the foundation class. We cover that quite strongly in that particular, class. So you could catch that there. Or better still, you could also cut the videos. I'm sure we must have done a video or two of this on the HFM, Nigeria YouTube. All right, it's 1 o'clock already. Please, do you have a video on Inshumuko on your YouTube channel? Yes, we do. Now, if you don't see it on HFM Nigeria, just search for HFM generally, right? In as much as we have HFM Nigeria, we also have the HFM channel itself global, right? You could also search there. We must have done, there are different webinars that we do every week, everywhere. So we must have done something on Chumuku. Just try and search for that and get that as well. Uh, let me see. I think I've answered this question as well. My main issue is how to go about the fundamentals. Try and cut those trainings that we have done. It can also help you quite strongly. Um, when are you guys coming to Kano? We have Kano on the schedule. I think if you check on the tools and education events, tools and education events, right, you should be able to see our coming event. Let's just check for Nigeria. We can see our coming event. So for Nigeria, Kano is not far. Kano is in August, 9th of August. Kano is not far. Kano is in August, 9th of August. So we're going to be in Kano, 9th of August, Mr. Dejomo. So you could also catch that as well. All right, guys. Let me see. Okay, I think we've covered quite a bit. Let me see if I'm missing anything at all. All right, not so much. What I'm going to do is I'm going to also drop the link to my personal chats just in case there's a question I was not able to attend to right now, or you probably have another question when you're watching this later on. So you can reach out to me, right? I'm just going to drop the link to my chat in the chat box right now. So please, if you have any questions at all for me, maybe later on, just click on the link. It will take you to my chat. You send me a chat and we can see how we can respond to it. But I want to believe strongly that, in what we have done in this 1 hour, we have talked quite a bit about how you can separate, filter general levels from your strategy from quality ones by adding different tools and confirmation techniques, right, to your entries. I want to believe we have done that. It's been quite a pleasure being with you this afternoon. We shouldn't really hold the time past the 1 hour that we scheduled for this, and that's what we have got into, guys. So we're going to continue this as well. Next week we'll do the VTF in the morning by 8 o'clock. We'll do the online training by 3 p.m. We have a webinar, I think, on Wednesday, Q&A session live on Wednesday as well. Trousers trading tip should be back next week, Thursday. And of course, on Friday, we'll also have another live session, IG Live. I'm going to be here together. We're going to get talking, keep the conversation going. Thank you very much for being with us. Thank you so much for spending this afternoon with us. Do enjoy the rest of your day. Enjoy your weekend, and I'll see you later on. Thank you. Goodbye for now.